Well, good morning, everyone. Good morning. It is Monday morning, November 25th, 2024. It is so good to see you all this beautiful, beautiful Monday morning in Austin, Texas. You all, thank you for joining our Thanksgiving week Monday morning touch point. Really, really excited to go over all that is going on within the Austin real estate market. Within the bond market, we've got a really packed meeting that we're going to get right to it. Thank you all once again for joining. I want to remind you that we do not have our Wednesday broker Q&A contract review and training. That is not happening this Wednesday. That is where all of us are going to be preparing for Thanksgiving. And of course, we do not have our Friday team meeting the day after Thanksgiving. We do not have our Friday team meeting. I want to remind you of that. But we're going to go ahead and do our mentorship meeting tomorrow at 10 a.m. Even though it is Thanksgiving week, I'm really excited to go over our mentorship meeting tomorrow. So if you want to join us live in person here at the office, so be sure to join us for that. That's going to be an absolute blast. I always enjoy our Tuesday morning mentorship meeting. I hope you all had an excellent, amazing weekend. But let us go ahead and start updating our favorite leading market indicator, the new listing to pending ratio. Let's go ahead and get this up and running. And first thing we're going to do, as you know, is go backwards in time and update all of the pendings for the previous week. So we're going to take this pending number from November 11th through November 18th, and we're going to change this to 375. That's going to bring up the ratio to a very encouraging 0.86, which is fantastic. Now we're going to go from the 4th to the 11th, and that's going to go up from 371 to 388, and that ratio is going to be 0.82. We're going to go from the 28th through the 4th. That's going to go up to 443. That ratio is going to stay at 0.86. 21st all the way through the 28th, that's going to be 435. Let's keep on going. 14th all the way through the 21st, 439. From the 7th all the way through the 14th, that's going to be 470. Great. Now we don't have to update anything prior to this. You can see that 2,442 open houses were held from November 18th all the way through November 25th. That is a drop, and that's to be expected. We see that when we're going into a Thanksgiving week. Now we're going to update from the 18th all the way through the 25th. Expect new listings to drop. That is what happens as we approach Thanksgiving week. I do not like to list properties 10 days before Thanksgiving. Better, if you can't list it 14 days before, wait until a week later. So we have 661 new listings that came in the market from November 18th all the way through November 25th. So we can expect a very healthy ratio this week. Less new listings, and then we have pendings that even if they stay healthy, it's going to drive the ratio up. As a matter of fact, let's take a look at the ratio last year. Take a look at this. Look at that, Thanksgiving week, 1.15 ratio. That was the ratio for Thanksgiving week last year. And if we even go back to 2022, that ratio was, there we have it, 1.27. And then it drops a little bit the week after. So we are expecting a really good ratio this week and then a really good ratio next week. Let's take a look at how many price increases. We are looking at 136. Less than, it's going to be the lowest price increase going all the way back to a month ago, October 21st through October 28th. What about price decreases? 1248. That's going to give us 90%, a little bit better than the previous 2 weeks. What about back on the market? We are at 150 back on the market, 23%. Back to 23%. We had a drop, 16% a week ago. We're back to 23%. What about active under contract? 420, not a bad number. So we are already at that 0.52 ratio, and we have not even added the pending information. So you all, this is where you get to guess over chat. What do y'all think? How many pendings over the past 7 days from November 18th all the way through November 25th? You know the drill. I need 5 guesses before I read out the number. So let's go ahead and just get some volunteers to guess. Okay, Sonia coming in at 218. Thank you, Sonia, for starting us off. We've got Harold at 220, slightly more on the bullish side. Seth coming in at a bearish 203. Let's get 2 more guesses going, and then I'm going to give you the number. We've got Kristen at 200, Joe at exactly 200. We've got our 5 guesses, you all. I hope you're sitting down for this because this is very encouraging. 2, 4, 3. We are already starting the week at a 0.82 ratio. And that is with rates inching up a little bit. The average rate at 6.84 for the previous week, up from the 6.08 back in September. Now, some of this is going to be seasonality because we are noticing new listings backtracking because of Thanksgiving week going into Christmas. But this is very encouraging. I like this. 0.82, not bad. I will take this all day long. Sonia said nice. I 100% agree. Very nice. I'm very happy to see us going into today with a 0.82 ratio. Really, really nice. Very encouraging. Cannot wait for next Monday morning touch point right after Thanksgiving so we can see what happened this week, the week of Thanksgiving. Now that we've got this, we're going to update the monthly information. Let me go ahead and update the previous month, October, pending. That's going to come in at 1681, 1681. Same thing, 0.79 ratio. We can now start updating all of the data for this month, November 1st, all the way through today. And we have, as of this morning, 11,570 active listings within the 6-county area that we are using for this data set. We use the 6-county area: Travis, Williamson, Bastrop, Hayes, Caldwell, and Burnett counties. Number of new listings, 2,406. Price increase, 563. Already more price increases than last month. Last month, we had 555 price increases. We had 563 price increases so far this month. So we have already surpassed October and September for properties that are going up in price. What about price decrease? We are at 4,088, 88%. Best reading going all the way back to March. Less price increases in relation. Very exciting. Back on the market. 469, 19% back on the market. Active under contract, we are looking at 1246 or 1264. And pending so far this month, 1016. We have already matched last month's new listing to pending ratio at a 0.79. Now, November of 2023, we had a better ratio at a 0.82. Right now, we're at a 0.79 ratio. But it's not a bad ratio. Way better than May, June, July, into August. So this is really encouraging. I'm really happy to go into this latter part of the fourth quarter with a 0.79 ratio. What about closing so far this month? We are at 1876. And let's take a look at withdrawn. We are at 710 withdrawn, 710. And let's take a look at expired. We are at, only 334. That's not bad. Because you can see that November of last year, we're at 470 for the entire month. We're at 334. More properties tend to expire towards December as opposed to November. But we're at 710 withdrawn. Last month, we had a ton of withdrawn at 1,036 withdrawn. Right now, we are at 700 110. Let me go ahead and just print this as a PDF so that we can review some of our amazing graphs and see what is going on with the entire market. Then we're going to take a look at the bond market, do a market overview, look at pricing, take a look at the economic calendar, see what's going on. Let me go ahead and just print this as a PDF so that you can see everything. Just give me 1 second so we can convert this as a PDF. There we have it. Let's take a look at the comparison. Same week, year over year. We already have 211 more new listings weekly, year over year. So far this year, 211 more new listings compared to last year. 61 more price increases, 632 more price drops, 24 more back on the market, 119, this is fascinating, 119 more active under contract, but 119 less pending. So that gives us exactly the same reading. But we know that the day is not over. We're going to get more properties that are going to go active under contract. And over the next few weeks, we're going to get more properties that are going to go pending. So we are going to have more properties going under contract this week compared to last year, same exact week last year. Now, last year, we did have a ratio of 1.15. We've got a ratio of 0.82. I would say we're going to settle around the 0.95. So when you look at the new listing to pending ratio, last year was better because we had way less new listings come on the market compared to this year. This is a really shocking number, 211 more properties coming on the market this week as opposed to the same exact week last year. I would say that has a lot to do with the timing of when Thanksgiving happened last year versus this year. So we're going to have to wait 2-3 weeks to see how this fleshes out. Let's take a look at the monthly comparison. So far, month over month, well, let's do year over year. Monthly, year over year, 369 less new listings on the market, but it is the 25th. And we are going to be positive. We are going to get 369 more new listings on the market between right now, it's 10:15, and the last day of November. So we're going to be on the positive side. We were 248 on the positive side last month, where we had 7.6% more new listings October 2024 versus October 2023. We're not going to hit 7.6%. We're going to be in the low single digits. We've already had more properties with a price increase this year compared to November of last year. Now, let's take a look at the pending, because we had 2 really good solid months where we had more properties going pending, active under contract plus pending, compared to the same month last year. And I would say that is going to be the case this time around. And you can see that when we have more properties going pending, look what happens the following month. We have more properties that will sell. A 6.7% increase on the number of sold properties October 2024 versus October 2023. And that's because we had a 11.7% increase on the number of pending properties. When pendings go up, sales go up, which is very encouraging. We are down 18.4% on the number of pending properties, but it is November 25th, and I do expect this number to shrink. Are we going to be positive? If we are positive, it's going to be the very, very low single digits, less than 2%. I'm not convinced that we're going to be positive. We need, well, let's see. We need 513 more pending properties that'll happen between now and the end of the month. 513. I can see that happening. So yeah, we are going to be positive, but I'd say it's going to be the low single digit percentage, but we are going to be positive. Let's look at a few more charts and see what's going on. We can see that the new listing to pending ratio at a 0.79, last year 0.82, the year before that 0.85. This matches the previous month. We can see monthly new listing to pending ratio. So we are down slightly compared to last year. We are 10.6% below average for the month of November, going all the way back to the year 2000. Let's look at a few more things. Here we've got active per 100,000 people, slightly over last year, 5.7% increase compared to last year. Cumulative new listings. Are we going to hit a record in MLS history on the number of cumulative new listings? We are up 8.1% compared to last year. Number of new listings actually went down last year compared to the previous few years. Last year we had 41,724 new listings come on the market between January and November, or from January and November. And so far, we've got 45,102. The record high was 2022 at 45,272. Are we going to get 170? Do you think we're going to get 170 new listings come on the market between now and November 30th? I would say we are. I would say that we are. So we are going to have a record year for the number of new listings hitting the market. Record year for the number of new listings. I'm going to go ahead and call it. We are going to see that. New listings per 100,000 people for the month of November. That's a record low so far. 95 new listings per 100,000 people so far for the month of November. That's amazing, isn't it? When you look at we had a pullback on the number of new listings in November, an increase in pending, but I still think because we saw so many new listings come on the market, February, March, April, we're still going to end the year as a record high year. We just had a pullback in the fourth quarter. I anticipate a resurgence on the number of new listings come January and February, but so far it looks like we're going to have a record year on the number of new listings that hit the market. Let's take a look at cumulative pending, total pending transactions from January all the way through November. Good news, folks, we're 6.6% above average. We're very close to last year. We're only off by about 300 pendings. We are down 0.7% compared to last year. When you look at the cumulative pending per 100,000 people, we are down 22%, slightly lower compared to last year. And a lot of that has to do with what happened first and second quarter. We've had a really decent third quarter. It's looking like a very good fourth quarter when we compare quarter over quarter. As a matter of fact, one of my projects for this winter break, not that we get breaks anyway, but I want to work on a quarterly analysis. So I'm going to create two sections, maybe one section on the website under Insight and Statistics called Quarterly Analysis, where we can start comparing quarter over quarter, Q4 versus Q4, Q3 versus Q3. Would that be helpful, you all? Just like a quarterly analysis? I like the idea of creating a quarterly analysis. I'm going to go ahead and do that regardless of what people say, because I look forward to seeing the data. So I'm going to go ahead and create that. Let's take a look at cumulative withdrawn plus expired. 13,008 properties have withdrawn or expired so far this year. That is amazing. 13,008, highest since 2011. When we take a look, let's look at a few more things right here. Take a look at cumulative sold. We are 9.67% above average on cumulative sold, slightly under, even though last month we had more sold last month compared to the same month, October of last year. We're looking at everything from January through November, and that's down 1.8%. When you look at the cumulative sold per 100,000 people, that's down 4.2% because population within the 6-county area increased, especially Williamson County, Hayes County. Travis County population went down, but Williamson County, Hayes County population went up. So when we take this into account, we are looking at 1,124 closed properties from January all the way through November, and that is a 20.4% drop. The new listing to pending ratio for the entire year, when we look at everything that went pending compared to everything that came on the market, including back on the market, we are so far at a 0.78 new listing to pending ratio. That's where we are right now. Let's take a look at inventory. As of this morning, there are 13,436 active listings in the entire MLS. That is a 6.08% drop month over month, but that is a 13.7% increase year over year. We're at 3,899 pending properties. That's going to be a 3.2% increase year over year. We got up to a 9.7% increase year over year, October 31st, and that shrank down to a 3.2% increase. Activity index, take a look at this entire column. We never hit 23%. We just go from 22 to 22.8, back down to 22.5. We're at a 22.5% activity index pending divided by active plus pending, 4.73 months of inventory. We are now under 30% activity index for new construction. We've been over 30% for a very long time. We're now at 29.93% activity index for all new construction properties, 18.82% for resale. Short sale, 36. We've got one added short sale right now. We were at 35. We're just inching ourselves up. So we've got 500 total properties that fall under the special listing condition. 3.72% of the entire market is the special listing condition, only 0.27% on the short sale category, but that number does come in at 36. Take a look at pending properties. We're only off by 3.2% compared to exactly the same time last year. Only 3.2% off. When you look at the activity index, we are 6.4% down compared to the same date last year. Out of the 13,436 active listings, 54.7% of those have gone down in price. 42.4% remain the same, and 2.9% have actually gone up in price. When you look at the top 30 cities in Central Texas that we track, 43% or 13 are in a seller's market, 33% or 10 in a neutral market, and 23% or 7 in a buyer's market. Going down to zip code, the 75 zip codes that we track, 35 or 47% are in a seller's market, 20 out of the 75 or 27% in a neutral market, and exactly the same number in a buyer's market. 60% of the 75 zip codes have less than 6 months of inventory. 40% have more than 4 months of inventory. Let's take a look at the zip codes that are very close to switching inventory. We've got 05 at 6.88. Give it 2 months. That's going to be in a buyer's market. We've got a few zip codes that are really close to making it to a buyer's market. And then we really don't have, okay, we've got 2.4, 77.24 just now crossed into a neutral market. But other than that, I wouldn't call 4.7 or 2.2 anywhere close. As a matter of fact, that's going to go down in inventory because active listings are going to leave the market through withdrawals, expireds, going pending, and we're going to have a break on new listings entering the market. So we're not at risk of having substantial changes on the number of zip codes. I would even go as far as saying that more properties are going to end up in a seller's market because we're going to have a lack of new listings entering the market simply because of the seasonality of real estate. And we're going to have a few that are going to be withdrawn and expired. So expect to see even more zip codes going up into the seller's market. We could even reach 50% of zip codes into a seller's market simply because of the seasonality of real estate. Let's take a look at pricing. We are up so far $14,750 on the month-over-month average sold price. Just amazing what's happening with pricing this month. We're up a shocking and amazing $36,186 year over year. The market is up 6.7% year over year when you look at the average sold price. When you look at the median sold price, we are up $5,245 month over month, and we are up $15,235 year over year. Another improvement that we saw is the sold to list price ratio. Last month, 97.03%. So far this month, 97.12%. A little bit less than November of last year at 97.15%. But I am really excited that it is higher than last month. So an improvement on the new listing to pending ratio. When you look at the average sold price, here's that 6.7% year over year increase on the average sold price. That's going to shrink the gap from the peak of the market until right now to 15.88%. And then on the median sold price, we're looking at a year over year increase of 3.6%. We're still down 20.87% from the peak of the market, but that has improved. So if today is the absolute bottom of the market and everything improves from today moving forward, the return to peak will be November of 2029. That is taken into account the 25-year compound appreciation for the Austin area market, which is at 5.047%. That would put us at a return to peak November 2029. That would be 61 months from right now. Now let's take a look at the entire year. The average sold price for the entire year, when you look at all 28,358 properties that sold, is at $567,921. That is a drop of only 0.2%. Last year, we had a drop of 8.3% on the average. When you look at the median sold price, everything that sold, the median sold price, $439,955. That's going to give you a drop of 1.2%. Last year, we had a record drop of 10.2%. So we're noticing improvements across the board. It's still a negative number, but it's an improvement. The other improvement that we're noticing is the sold to list price ratio. It's not decreasing. It's not getting worse. It's getting better. 97.4%. Last year, 97.2%. So that's very encouraging. We've got more good news than bad news. And that's the good thing. We've got an increase in pending, increase in demand. We've got stable pricing. And this goes back to what I've been saying is that at worst, we have a little bit more correction on the market simply because interest rates are still on the high side, really encouraging what's happening today. We're going to review that here in the next 30 seconds. But some areas are still overpriced, and people were not making enough to justify the PITI. So we could very well see a slow pullback, especially with inventory increasing first quarter of next year. You still have to price your properties very aggressively. You've got to price it right. Buyers still have the leverage for the most part in this market outside of certain zip codes, certain neighborhoods. Buyers still have the leverage. But we're 90% there. We are 90 to 95% there when it comes to pricing correction. We are not seeing what we saw last year, a 10.2% drop. I mean, you can see this going all the way back to the year 2000. I mean, it's just It's a huge number. It's a massive number. So the fact that we're at a 1.9%, the fact that we're not seeing double digits is very, very encouraging. We are expecting 2,163 properties to close this month. That's going to be an improvement from last year. Also good news, more good news than bad news, and that's very encouraging. Very, very encouraging. Last month, we had 2,455 properties close, which we even beat September. September, we only had 2,300 properties close. So October was better than September, and historically, that is not the case. You can go all the way back. We have 1, 2, let's see, 1, 2, for the most part. So I've got 2, exactly the same. Let's see. So out of the past 25 years, we've had so far 2, 3. Let's see. 3. We've had 3 and now 4. 4 out of the past 25 years. October was better than September. And here we had the 4th one this year where October was better than September. That's very encouraging. Now, do we see November being better than October? No, we don't. I do not forecast. There's no way, I'll call it right now, there's no way that November is going to be better than October. But statistically, that's nearly impossible because of the seasonality of real estate. We don't expect that. In this case, what we're looking at is year over year. And we do expect year over year for November 2024 to be better than November of 2023. And that's good. That's very encouraging. October, that was the case. October was better than October 2023. And now we're going into November. Also better than November of 2023. So that's very encouraging. I'm very happy to see this. This translates into the number of sold properties per 1,000 realtors. And you all, I've said this before, I'm going to say it again, I could not be more proud of the work that you all are doing. You all are doing amazing. Absolutely just hustling, working your absolute tail off, staying in touch with your people, doing your market reports. Your pipeline is filling up. I am so incredibly proud and grateful of the work that y'all are doing. Way to go. Way to end the year strong in laying a really good foundation for next year. Very exciting to see what's going to happen next year. Last month, we had 132.5 number of sold properties per 1,000 realtors. Way better than 2023. Substantially better than 2022. The forecast for this month, right at 15 or 115, matching September of 2024, but way better than 2023, way better than 2022. So we are expecting a higher degree of production per 1,000 realtors this November compared to November of last year and November of 2 years ago. So that's also very encouraging to see this. Now let's talk about rates. A major cabinet announcement was made right before the start of the weekend. In which announcement was that? Well, like 10 were made in the past, few days. So like a bunch of them are being made. But one that really impacts us. There you go. Violet is absolutely right. We've got Scott Bassett. Bassett? It's with a E, not with an A. Scott Bassett was appointed or nominated, I guess the best word is nominated, to be the Treasury Secretary. And that's a big deal because it affects bonds. So when the bond market opened in Japan, because that's the first market that opens, everyone was like, okay, how in the world is the market going to react to the nomination of Scott Bassett as the Treasury Secretary? Now, his background is interesting because seasoned hedge fund manager, like very, very seasoned hedge fund manager. and founder of Key Square Group. And if you do some research on him, I mean, just go ahead and do your own research. But I would put this nomination on the fiscal conservative side and on the free market side of things. Mainly he's made a lot of comments over the years on pulling back on budget deficits, that it's unsustainable, the path that we're going for budget deficits. We just crossed $37 trillion. It was $279 billion just last month on budget deficit. And every political group going back to, 40 years, they've just been awful when it comes to budget deficits. I don't care, conservative, liberal, they've all been awful when it comes to overspending. And Scott Bessent has been critical of that. So that's a fact. So it's going to be, and he's also expressed a very cautious approach to implementing tariffs, which is interesting that he was nominated, because the person who nominated him is very much pro-tariff. So he nominated a Treasury secretary that, for the most part, it's not anti-tariff, but has expressed caution on tariffs. It's like, hey, we don't want to implement tariffs to the point where it becomes inflationary. That's an interesting appointment. And that's going to be very interesting to see how this plays out, but we know how the market reacted to it. Because the second that the bond market opened in Japan, if you have less treasuries that are available for auction, and then what happens with the price? If you have less than a product, so if the government is serious about reducing deficit, if they're serious about spending money that they have as opposed to spending money that they don't have, meaning you don't have to issue more debt for the things that you're going to spend money on. So you're going to have less of an asset, right? So the government only spends money there are two different pots of money that the government uses to spend: tax receipts and what? Debt. That's it. And inflation. You can throw inflation in there, which is a tax on all of us. So that goes under the tax receipt. But you can either raise taxes, or you can use the tax money coming in, or you can raise debt. And we've been raising an obscene amount of debt. So if Scott Bessent, who is known to criticize the amount of debt that's being issued and the overspending, and if there's a pullback on the amount of debt issued, then you're going to have a pullback on the availability of that debt. So demand for that debt will then increase because you have less of it. If demand for an asset increase, what happens to the price of that asset? If demand for an asset increases, what happens to the price of that asset? Goes up. It goes up. If the price of an asset goes up, what happens with the yield? It goes down. So this is how the market reacted to that appointment. A massive drop on the yield. A drop so far of 10.4 basis points. So much so that for a moment, we actually crossed over two repricing lines. So the market reacted in a very positive way for this appointment. And I would say because of two reasons. One of them is, regardless of what political spectrum that you're currently on, I don't care if you're libertarian, I don't care if you're on more the progressive liberal side, I don't care if you're on the conservative side, everyone can agree that $37 trillion in debt is insane, it's not sustainable, something needs to be done about it. But the other side that the market really appreciated was, well, this guy has expressed caution on implementing tariffs. So, okay, well, good. That's a good thing. We don't want to be so outrageously aggressive on tariffs that it becomes inflationary. So it was an interesting appointment. And this is how the market reacted to that. Now, we are seeing a little bit of a pullback right there. So we now are over this second repricing line that we crossed. But we are at 6.875 right now. If the trend continues, we could very well have a repricing down to the 6.75. But we have to realize that the market always overreacts, and then they read the entire, then they pause, then they think, then they read the footnotes, and then the market adjusts. So we just have to wait a few days to see how this is going to play out. That's just how the market reacted initially. And we can see, and we've been doing these meetings for a very long time, that we've had many situations where the market's like, I love it. Oh, wait, what did it say? I love it. Wait, what did it say? I love it. Wait, what did they say? I love it. What did they say? And now the market is on a I love it. Is the market going to go, wait, what do they say? What's going to happen? So we just have to be cautiously optimistic with the way that the market is reacting to the news. And we're just going to have to just every week we get together, we go over this information, we go over it on Wednesday, we go over on Friday. But so far, when it comes to us, because that's really all I'm interested in, it's like, how does this impact interest rate? That's all I care about, y'all. I am politically neutral when it comes to all this news, other than how does it affect mortgage rates? How does it affect interest rates? What's going to be that daily effect that it's going to have on that specific buyer or seller and demand for real estate? That's all I'm here to analyze. Nothing more, nothing less. And we can see that we had a very positive impact on this, a little bit of a pullback. I will continue to send you screenshots over the week through our internal Facebook group. If you're not a member, please be sure to join that so that you can see what's happening with the bond market. But so far, so good. I'll say that much. I like it when the yield goes down. Why would I not like it when the yield goes down? I love it when the yield goes down. Let's take a look at the economic calendar, because as of this morning, we had Chicago Fed national activity. That was a little bit worse than expected. Business manufacturing index, a little bit worse than expected. We had a 3 and 6 month auction, 3 month better than the previous, 6 month. It was not better than the previous, so that's really interesting. Stock market also liked that announcement for Scott Bessent to be the Treasury Secretary. That's going to be interesting. Wait, didn't he work for like a George Soros fund also? Am I wrong? Did I read like the different headline? Someone correct me. Someone Google that. I thought that he worked for like a George Soros fund also. Once again, interesting appointment, right? I mean, I think it's fascinating. Yeah, he was. So let me see. Let me do a little research right here. We've got tenure with George Soros positions him as a stabilizing figure capable of navigating economic challenges. Okay, very interesting. We're just going to have to wait and see how this plays out. This is from Market Watch. That's what it is. Market Watch. It's having me subscribe. I hate it when websites do that. Let me go ahead and just put this. There we go. U.S. government bonds stage biggest rally in nearly 4 months after Bessent picked for Treasury. There we have it. Did they mention here Soros? Yeah, there we go. Bessent, a hedge fund manager who in his career has worked for legendary investors George Soros and Stanley Druckenmiller. Boy, wouldn't you like that name, Druckenmiller? Was judged to be the most market-friendly of Trump's potential choices for Treasury Secretary. This pick should please markets given Bessent's in-depth understanding of financial markets and the economy, in particular the bond market. Okay, so very interesting. This is from Krishna Guha. And there we have it. We're just going to have to see how this plays out. I do believe that there's going to be a correction on this. We are already noticing. So look at that. That's already going up. So we always have to wait. We can't be overly excited on this massive drop. We're going to have to wait and see how the market approaches this. Violet Leff, go for it. I hope you had a great weekend. Feel free to unmute yourself. Go for it.
Okay, so I have a question because this seems unbalanced. He wants to decrease the deficit spending. Amazing. Great. But you said it has to come from someplace, which would mean it would have to come from taxes, and the president-elect wants to reduce taxes. So how does that work? And if you do reduce taxes, which of course we would all like, you put more money into the system, which in addition to tariffs can also cause inflation. So that's why I'm confused.
Yeah, I'm skeptical of every politician that says that they want to reduce deficits, especially when I don't see any track record of a single one of them actually reducing deficit. I mean, the only administration that actually had a budget surplus was Bill Clinton when Newt Gingrich and the conservatives took over Congress, and Newt Gingrich proposed the Contract of America and basically started saying no to every single thing that Bill Clinton was proposing. And for that very short period of time, both parties were able to negotiate not only a reduction of expense, but a balanced budget. And the country actually went through, I believe it was no more than 1 or 2 years of a budget surplus. And it wasn't a massive budget surplus. It was a surplus is good. But since then, it's just been an absolute catastrophe. And there's no evidence of a single political party or person being able to accomplish what they promise. So I am so skeptical, and let's wait and see what happens. I doubt it's going to happen because the spending is so outrageously high when it comes to entitlements, when it comes to Medicare, Medicaid, Social Security. Defense, of course, is absolutely outrageous. And then everything else and every other pet project that politicians approve across both parties. That's just been the reality, unfortunately, for over 20 years. But if they actually want to get to the point where they have a balanced budget or a surplus and reduce the deficit, there's no way, in my personal opinion, that can be done without massive cuts in programs that they've promised not to cut: Medicare, Medicaid, Social Security, and then also an increase in taxes. Like, in my opinion, the math simply doesn't work. So what we're left with are promises that are simply not going to be fulfilled. I don't see an environment where we don't look at this 4 years from now and we're like, okay, great, we went from 37 trillion, now we're at 43 trillion. Maybe it was a little bit less than previous, maybe it was a little bit more. But at one point, they're just going to have to cut the big items like defense, Medicare, Medicaid. At one point, they're going to have to increase the age for Social Security. But no politician is ever going to get elected if they say that. And that's where I've been saying for years, we get the leaders we deserve, right? Because we're not going to elect people like Milei in Argentina that actually goes in and just says, right, this is enough is enough. Like, we are being drunks here and we simply don't have this money. And Argentina now has a budget surplus, which it was a collapsed economy prior, and now they actually have a budget surplus. But this guy, and I don't know what their constitution is. I don't know what they're allowed to do at the executive level where they don't need congressional approval. I'm not familiar on that side with Argentina. But Argentina's economy right now is just phenomenal, just great. But he just went through the chopping block. I mean, he just cut everything. No way that we're on that stage. No one's going to vote for that. No one has the tolerance for that. But we also didn't experience the decades and decades of the pain that the Argentinian people experienced. So will we eventually have the desire for that level of change? Maybe 20 years from now. But we're going to have to experience a defaulting currency, a defaulting economy, a defaulting bond market like Argentina did. Only then will we say, shut it down. Like, just cut all this nonsense. We're not there yet. We're not there yet. So, no, I don't see any of that being accomplished, Violet. I just don't. I'd say go for it, whatever. Let's just wait to see what happens. I would say when we blink and we're here 4 years from now, we'll probably have $41 trillion in debt and kind of same old, same old. That's my, and I'm simply evidence-based. Like, Now, if they come in and they're like, hey, you know what? We're slashing defense by 50%. We're not spending $900 billion. We're spending $400 billion. We are raising the retirement age on Social Security. Like, it is what it is. We are cutting Medicare, Medicaid. We're going to do it, and we're going to have to increase taxes by 25%. Then I'll start taking that seriously. It's like, oh wow, they're actually serious about balancing the budget by decreasing the deficit. But until that happens, like, I just don't see the evidence of it. Does that answer your question?
No, but that's okay.
It doesn't. So can you repeat the question?
Well, because
I thought I
like
answered
you
the question.
the market reacted to him positively
Yeah.
because of his stance on deficit spending. So that's, like I said, if he was brought in because of that, I don't understand, like you said, how you can accomplish both, how you can decrease the deficit without increasing taxes. And if you do increase taxes and you have tariffs, you may have inflation again. So
Yeah.
that was kind of,
I mean,
I didn't understand how all of those things work together.
well, at one point, it's are they going to actually slash spending at a obscene significant level, right? At the $2 trillion mark. That's going to be it. Are they going to shut down entire departments and shut down from defense to, I mean, are they going to decrease spending like absolute maniacs? And I would say that this appointment shows that there is a serious intent on decreasing spending. Right? There's a serious intent. Whether that's going to happen or not, time will tell. We just simply don't know. But this appointment certainly points in that direction, which means that less debt is going to be auctioned, which is contributing to a decrease in the yield because people want to lock in a high yield environment, which we're at 4.29 right now. So let's go ahead and lock that in for 10 years, because if we've got less debt that's going to be issued, more demand for that debt is going to exist, which is going to drop the yield even more. So what the investors are looking at, they're saying, well, let me go ahead and just buy this 10-year Treasury at 4.25, because next year it could be 3. And now I've got an asset that actually increased in price and I've got a higher yield. So it points in the direction that they're serious about spending cuts and they're serious about being way more fiscally prudent, but time will tell. So this is where I separate the question. Like, this is how the market is reacting right now, but am I confident that that's going to happen? Well, just not really. The time will tell. I hope we spend less as a country. I don't want my next generation to be saddled with this nonsense that we were given. I hope they're serious about cutting spending. I hope they're serious about cutting spending. But every administration has said that, like I said, since Bill Clinton. So time will tell. I'm very skeptical when politicians say something because there's evidence of that. But so far today, good news. We're noticing right now 11.1 basis point drop. So that's very, very exciting that we are noticing a really nice, decent pullback. Let's see. Do we have anything else going on? You all, tomorrow is going to be absolutely crazy, insane when it comes to economic news. Look at everything that's being released tomorrow. Unbelievable. We've got building permits. We've got house price index. When a house price index gets released, we're going to be able to update our house price index on teamprice.com. We're going to be able to update the home price index that's by Freddie Mac. We've got Case-Shiller, HPI. We've got consumer confidence, new home sales. We've got a lot going on tomorrow. And then let's go ahead and take a look at Wednesday. We've got a ton going on Wednesday. We've got mortgage applications. We've got inflation data. We've got a lot going on. This is going to be a really, really packed week when it comes to data coming out both tomorrow and Wednesday. We've got pending home sales. We've got core PC, personal consumption expenditure. There's a ton going on over the next 2 days. So as much as we like seeing the yield drop by so much is going to happen over the next 2 days. It's just going to be crazy and insane. We could have higher than expected inflation numbers, lower than expected. This bad boy could go all the way back up and hit record highs. Or if we have really good, solid, positive inflation numbers where now inflation is going down again, and we've got other indicators that contribute to a drop in yield, we could very well end the week at under 4.2. It's a winner take all environment that we're currently on. It could be way high, it could be low. I will keep you posted. We'll update everything. But so far, so good when it comes to the yield. Any questions, you all? Any questions, comments, concerns, criticisms, complaints? Do not forget, I want to give you this one update right here. We have a really, really exciting contract proficiency, a super exciting contract proficiency challenge. It is a unimproved property contract. We don't do many unimproved property contracts, but it's important for us to practice unimproved property contracts so that when you have a client that's going to be submitting a unimproved property contract, you know what to do. So here we have it. This is in Spicewood, $390,000, 25% down, 8.75% rate, amortized in 30, due in 7. It is very common for unimproved property contracts to have a balloon payment, a 30 due on 5, 30 due on 7. That's why we went ahead and included this within the contract proficiency challenge so that when you are structuring the third-party financing addenda, you know what to write there. And then something very interesting happens when a client is purchasing a unimproved property contract is that if they want to build a house there and that piece of land requires a septic system, they ought to do what's called a perk test. That's a percolation test, where they simply dig a hole, they pour water, and they measure the amount of time it takes for the ground to absorb the water. And that's going to determine whether the septic system is going to be a drain field or if it has to be an aerobic septic system. That's going to influence not only the location of the septic system, but the cost of the septic system. And that is something that I've always recommended that my buyers do during the option period. So I'm planting that seed on your head of like, hey, by the way, when you work on an improved property contract, this is what you ought to know. But here we have a situation where the septic company recommended the following language. During the option period, buyers granted permission to conduct a percolation test, perk test, to evaluate the suitability of the property for septic installation. Buyer shall coordinate with seller landlord to schedule, should just be seller, but I just copied and pasted this because that's what the septic company wants. So we just put that there. To schedule the test to ensure minimal disruption to the property. Buyer agrees to provide seller landlord with a copy of the test results upon completion. Because this is a evasive test, meaning you're actually digging up the ground, the buyer does not have the right to do that unless it is approved by the seller in writing. So that's why we're doing this. So please do the contract proficiency test. Go ahead and get that done. Unimproved property contracts, super important for us to know how to do this. Any questions, you all? Any questions, comments, concerns, criticisms, or complaints? Sonia Komisarenko, go for it.
Morning. This has been asked before, but I don't know if anything changed or or anybody else knows, but my client that I have a listing with, they want to now also list it for lease. And Zillow does not allow or did not allow for sale and for lease. Is there any changes on that? Because Zillow will not show it as for lease.
I had no idea that that wasn't even something that they allowed or didn't allow. Anyone else want to jump in that knows the answer to this? I didn't even know that there was a restriction. So anyone else encounter this? Anyone else have this issue?
So, yeah, they only allow you to have one listing as far as I know. So I've had the same issue. Okay, and that's going to be an issue, so I don't know.
Okay.
The other question I have is they definitely want to sell the property, and it's going to be a lot harder to have a tenant in there in the environment that we're in because investors are not going to, I mean, we've gotten several investors offers and, they're ridiculous to the seller, right? Because they're $120,000 or $150,000 less than list price. So they want to do just short term, and I don't know, what do you think about that? I mean, they want to do 3 to 5 months at the most, so then they can be sure that, or not sure, but there will be a better chance to sell it in the spring. Thoughts on that?
I mean, go for it if that's what they want. I would, if your desire is to go ahead and list it, are you going to leave it on the market until the spring and just see what happens? Or if it leases, you're going to take it off the market?
No, they want to leave it on the market. They want to sell it. I mean, the lease is only to help them with the payment. I mean, I know they can afford them. He said, well, we're straining. I mean, I know what their situation is, but at the same time, I mean, the payment, it's a whole bunch of money, right? And it's been on the market for a while. So they just want to help themselves to some money. I just said, it's going to be very difficult unless it just happens to be that one family that is building and they need a 3 month lease. I mean, the chances of that are what? 0.01%?
Well, that's exactly it. I mean, if you can get a 3-month lease and then they're out of there by February, in that case, I would even take it off the market and then relist it in February, reset the ADOM. I mean, if it's having a hard time selling right now, it's going to have even a harder time selling if there's a tenant in there. So if their primary goal was to sell it, then I would not do the lease. I just wouldn't.
Yeah, they were asking me about it, and I told them yes, and we were gonna do it. But okay, I'll have a chat with them.
Yeah, I
See
mean,
if
the
there's
challenge is if they do a 5-month lease, anything 3 to 5 months is going to be very hard to find a tenant.
right.
Very hard. So which to that point, leave it on the market and you don't have to deal with it. Let's just say you get a tenant in the property, then you can just about forget selling it until you're either very close to the end of that lease and at that, you're not going to be able to you're going to need an investor that's going to be the buyer of that property, not a homeowner. So in that point, I would just take it off the market and then relist it when that lease is 60 days out from that tenant leaving.
Yeah. Okay. All right. Yeah. Thank you for the input. I will have another conversation with them.
Sure.
Appreciate it. Thanks.
Of course. Good stuff. Any other questions, you all? Any other questions, comments, concerns, criticisms, complaints? Anything about the market? Anything about real estate? We do not have a broker Q&A on Wednesday. Keep that in mind. No meeting on Wednesday. We do have our mentorship meeting tomorrow. We're going to go ahead and do that. But we do not have a Wednesday and we do not have a Friday. Any last minute questions?
Can I have a question?
Yes, Anaí, it is so good to hear your voice. Go for it.
Hey, so quick question. I have a listing and the tenants moved out. The owner unfortunately didn't leave the electricity on. How do we know when the pilot is on, or who does that for us?
You can have, so this is going to be the pilot light for the water heater, correct?
Yes.
Okay. So there's a little box in front of the water heater, and I certainly don't recommend I'm answering the question as a matter of fact, not as a instruction for the landlord to start messing with gas and electricity, right? I don't want the poor owner just to, blow up in his face and is like, well, the broker taught me how to do this. So this is more of a Q&A as opposed to, hey, go do this. But there's a little box on the bottom of the water heater that if you unscrew and pop that out, there's a little knob to adjust the gas, and that's where you can just either hit a button or you can light up the pilot light in order for it to, light up and just start heating up the water heater. But with anything related to appliances or anything like that, there's a gentleman by the name of Mr. Appliance. He's really, really good. High star ratings. He's all through Central Texas, more on the handyman side of things. Give him a call. I wouldn't go the direction of a plumber or anything like that. It's super hard to get people like that. But just a appliance person that can come in and be like, hey, we had to turn on the gas. We had to turn on the utilities. The water heater's not on. Pilot light needs to be turned on. How much would you charge just to come here and turn on that pilot light, check the water heater, make sure everything is fine? That would be my recommendation for the owner of the property. Obviously, if they don't want to spend money, they can just Google it and they can just figure it out. But it's a very, very simple process.
Thank you.
Yeah, of course, anytime. Good stuff. Any other questions, you all? Any other questions, comments, concerns, criticisms, or complaints? Going once, going twice. All right, good stuff, you all. Thank you all so very much for joining. Super appreciate it. I will see you all tomorrow, hopefully, for our broker mentorship meeting tomorrow, 10 a.m. here at the office. If you can make it, great. If not, totally understand. It is Thanksgiving week. Otherwise, no meeting on Wednesday. Of course, no meeting on Friday. Be safe out there. Enjoy shopping for Thanksgiving. It is crazy. The stores are just insane. I went to Costco, H-E-B, and Whole Foods yesterday, and it was just a madhouse in all three. It was dreadful. But be safe out there. If you need anything, let me know. Here to help. Otherwise, have a great rest of your day. Be on the lookout for this recording along with a meeting summary. Talk to you later. Thank you all so much for joining. Bye.